Welcome back. Today I am releasing my Palantir report I've been working on for the last few weeks. I made a video on it. It's now available to download if you are inclined to do so. And I'm also releasing the private Palantir valuation model that supports everything I talked about in the report. And for this video, I'm going to walk through the base case. If you want to get access to the bull and bear cases, you can do so with the link in the description. But I want to walk through my thinking here, and hopefully this will be of benefit to you. So we'll start off with the revenue build, and this is essentially Palantir's two core segments. We have the government revenue, the commercial revenue, how that sums to the total, and the gross margin over time. So I have done a 10-year forecast, and you'll see 3 years of historical data, but all the way through 2032, this is what I am forecasting. So for government growth, it gets more difficult over time considering how much Palantir has already penetrated the government segments. That said, with their net dollar retention at 115%, I think it's safe to assume 110% is for the government. So government institutions are growing their spend with Palantir if they're able to, get 5 to 10% of new clients on top of that itself to what I have here of 15, 16, 17. I believe there will be a bit of a government rebound over time, and then tailing off towards the end of the projection period. I think this is fairly conservative for the base case. And for commercial, I have commercial revenue also getting a bit of a rebound, slowing down this year, but accelerating as the product is getting more mature and Palantir's sales efforts are increasing. Everything I discussed in the report, consumption-based pricing, modularity, and so forth. But these are the numbers. I really do think Palantir is going to have a good next few years. That's going to drive growth higher. So overall for the base case, I'm expecting growth of about 20% this year, but accelerating a bit, almost to 25% mid-decade, and then falling back off to 20%. So all in all, this is definitely not a significant growth from Palantir. I would say it's definitely more moderate. I think this is a decent base case. They've done some incredible growth figures previously, 44%, 41% if you take it all in full. But this is a very difficult operating environment. Growth is harder to come by, especially in recessionary times. It's impressive enough to retain all your customers, let alone be growing at 20%. So that said, that is where I end up. And I also want to mention, as a percentage of revenue, I'll zoom in so this is easier to see. But the base case, I want to show you what it actually turns into. But right now it's about 56% government, 44% commercial. And over time I have this flipping. So it flips to 33% government and 67% commercial as a result of how fast I believe the commercial business is going to grow. What's going to happen to the gross margin, in my opinion? We're about 79 right now. And so I think Palantir's gross margin is going to continue to expand over time as a result of flipping more to commercial revenue. And the mix shift to commercial will actually boost gross margins because there are less professional services involved as there are with the government side of things. So that's basically our revenue build here. Now we'll get into some of the drivers, and then we'll get into the model. So SG&A as a percentage of sales, I have forecasted Palantir with GAAP numbers. And so on a GAAP basis, not excluding stock-based compensation, this is where we end up. And so I have SG&A as a percentage of sales continuing to fall off. This is a little bit more aggressive than what the street is expecting, but I did want to do it this way nonetheless. I do expect Palantir to normalize their stock-based compensation pretty significantly. Same sort of deal with their R&D as a percentage of sales. I think they're going to work hard on normalizing their stock-based compensation across all of these lines. Depreciation, amortization, just kept it a flat line all the way across. And then stock-based compensation as a percentage of sales. This is more for the non-GAAP calculation, but here's what I'm anticipating. I think it's practically going to drop in half. It's dropped in half of each of the last 2 periods, basically. I'm expecting it to get cut in half one last time over the next 10 years. And the tax rate, this is fairly interesting, actually. Obviously, all corporations have to pay taxes on profits, but Palantir's had some deferred losses, and so I'm not exactly sure because I couldn't find it I didn't look too closely, but I didn't see it on the balance sheet. If they have a deferred tax account, it might be lumped in with something else. But that said, it is going to reduce their taxes going forward. So I have their tax rate gradually ramping up. In the bull case, it's higher because they'd be making more, but you get the idea. CapEx as a percentage of sales. Obviously, Palantir is not a CapEx heavy business. Based on the historicals, just put it at 1%, and that is that. So on the weighted average cost of capital, this is essentially the discount rate. Let's say Palantir valuation is worth $20 in 10 years. Well, what does that equate to in today's terms? You obviously wouldn't pay $20 for something that's worth $20 in 10 years. You want to actually discount that back to find what the present value is ultimately worth. So that's what our discount rate is trying to actually get a good handle on. And so the weighted average cost of capital is essentially an academic way of taking a look at it. And so we balance Palantir's debt against their cost of equity and so on. And you might be saying, oh, well, Palantir has no debt. And so what's interesting is I was looking at Bloomberg. They have the WACC at 11.7. I actually went through and got 11.6. And so ultimately, their debt, they're using operating lease agreement as a amount of debt, which I think it's not too significant. As you can see, it's only 1.8% compared to all of the equity that they have. But I included it nonetheless. It's not conventional debt, but wanted to run it through. So our discount rate is 11.6%. Here's the income statement. What we have here, I'll zoom in, is the historicals. I have all of these quarters that data was available for. And so you can definitely feel free to go through and take a closer look if you have access to the valuation model. And yeah, so here's the income statement with all of the drivers I was just mentioning and adding back stock-based compensation to get non-GAAP figures. Stock-based compensation as a percentage of revenue. There's a non-GAAP operating income and so on and so forth. We get down to EPS and non-GAAP EPS, and that's ultimately where you would take a look for that information. And the segment data. So this is where I'm taking a closer look at how many clients they're actually going to add each year. And so they added 17 government clients last year. And so if they're able to do 15, 15, 20, 20, 25, 30, 35, you get the idea. This is what their average contract, or rather revenue per government contract client is actually going to look like. And so you can see I actually have their spend increasing over time. And so even with this many new government clients, the spend actually really has to significantly increase. And so that just shows you growth is going to be fairly difficult on the the government side. It's not going to be very straightforward. Definitely growth at this scale is the bigger Palantir gets, the harder it is to it's just you start to realize that when you model it out. It's definitely not going to be the easiest thing, but I believe Palantir has the best technology for this type of application, and so I think they will succeed. I just want to make it clear that it's definitely going to be an uphill battle on the government side. And on commercial clients coming in 260, I think they're going to, we've seen what Either Square has been doing with the links. I think they're going to significantly increase this. I really think now is the time for commercial going forward. Obviously not, immediately in the current environment, but next few years, I think commercial is actually going to explode. I think it's going to be the growth driver of the business. This has been my thesis from day one. And you can actually see spend last year, $4.1 million per client. I actually have this decreasing because I think they're going to get so many new clients. It's going to be less than that for the entire projection period, which I think makes sense, right? Medium to small size businesses. I've been saying this, pretty much before anyone else, and that's what I'm forecasting here. So here you can take a look at some more, ratio analysis. But what I really want to get into is the DCF. So what you've been waiting for. We've gone through all of the information. And what we have here is the base case at a 11.6% WACC, a 3.5% PGR because this is only 10 years and Palantir just turned profitable. And ultimately pulling all of this information in through the work that we just did, you get the present value of those cash flows, and it comes to an $11 price target, which is actually more than 32% upside because I forgot to update the current share price. I believe we finished over $8, $8.09. So about 34% upside. That's what I have in the base case. If we go and compare myself against what the street consensus is, here you will see the difference. So the street's expecting 2.2 billion in revenue, but it's worth noting guidance on the high end is 2,230, and Palantir tends to outperform guidance by about 8% if you look historically. So if you add 2% to that, you get 2,275, which is exactly what I have, which I think is definitely likely. So that 3% difference, I believe it's the street underestimating Palantir. They should have learned by now, especially on sales. It doesn't work out well. You have that greater increase over time because the street is expecting such a slowdown. And I actually think growth is going to reaccelerate. We talked about the margin. The street's higher on margins, for gross margins at least, but that's because I'm expecting doing more free work up front, which weighs on the margins, but that's how they're able to get so much growth over time. And then compared on EPS, I am above on all of these 3 years, but not significantly. The more I looked into it, it doesn't look like Palantir's going to beat on earnings. I think what they're going to be able to do is beat on growth, which is actually more important in my opinion. And so back on the DCF, this is ultimately what it comes to, a 34% upside, and this is actually very sensitive to the weighted average cost of capital, which actually includes, yields and that's effect on the equity. Like we can look at the risk-free rate, for instance. This is the 10-year yield is what I used. And so we can say, well, what if inflation gets under control, yields come down, and everything like that? What if yields come down to 2.75? Well, all of a sudden the WACC is 11. Let's take a look at the effect on the price. 48% upside. It's a $12 price target. So you can see how sensitive it actually is, as you would expect, because Palantir is a fairly high duration company. Even though now they're profitable, you can actually do a DCF forecast. Before, you had to adjust the numbers and then do it. And so this is strictly based on Palantir's profits going forward. So I think more investors are going to consider Palantir as a potential investment because of this gap profitability. That's why it's so important. Before you had to adjust the numbers, and now you can. I think it's going to be a bit of wait and see, but I'm certainly out in front of this. I believe they're doing exactly what they're saying they're going to do, and the future is definitely bright for Palantir. You can see like the effect is even greater on the macro side of things with the risk-free rate and so on. And so let's say it got down to 2.5. All of a sudden we're over 50% upside, and this is just the base case, right? Yeah, I think Palantir certainly has upside. This is, in my opinion, based on my research, without rates coming down, but I think rates are coming down. And I think it's going to be, a big moment for Palantir stock when all of the headwinds are cleared, because it's really been facing a lot of challenges, internal growth slowdowns, the very difficult macro environment, and so on. And I think Palantir is going to meet its moment in the next few years, and I think the stock is definitely going to realize that. So it's definitely tough to say when that would happen, but I'm bullish on Palantir. To be clear, there are certainly downside risks. You have to assume growth is able to stay at a decent level. Sure, it could be higher. I think there are risks that it could definitely be lower. I think margins are less of a concern as long as they're able to normalize stock-based compensation. I think that might be a bit difficult. I think cutting back that much while still growing is certainly a concern. I don't think gross margins are a concern, but I do think their operating margins, can they cut stock-based compensation so much and still put up these really impressive numbers? I think that remains to be seen, but once it's seen, believe me, the stock will move. I don't think Palantir is just going to ignore the numbers. I think Palantir and most stocks, stocks follow earnings. And so if Palantir is able to beat earnings, it's going to happen. It's going to happen. And so revenue per employee, I just wanted to, highlight a couple more things. This is what I'm estimating Yeah, it's just an interesting look at the historicals here and my forecast as well as sales efficiency. And so this was something I saw in one of the analyst reports. You can actually sort of calculate a um, customer acquisition cost essentially and lifetime value and then divide those two. And you want to see lifetime value to CAC actually increasing because lifetime value is divided by how much it actually costs you to acquire them. The numbers are going to be looking great for Palantir going forward. That's the bottom line. Hopefully you enjoyed this run through of the DCF. Hopefully it was helpful, and definitely check out my Palantir valuation model in the description below. Put in your own numbers. I think you'll enjoy it. Until next time.